All right, we are still on chapter 7, and we're doing sales returns now. So, merchandise can sometimes be returned, and we can get a refund or credit from where we had purchased it on credit. Okay. There could be a special price reduction called an allowance. An allowance may be where they don't return the product, maybe it was the wrong color. It wasn't the exact right product, but they could still sell it. So they're just going to give them an allowance. Okay. And um, so it's kind of as an incentive for the customer to keep the product and them actually make something off of it rather than nothing. Okay. We would accrue any sales returns and allowance at the time of the sale. Otherwise, recognizing sales returns only when they occur could result in an overstated income in a period of sale and understated income in the return period. Okay. This is one of those things. We'll talk about this when we get into audit, where we you might see a big sale right at the end of the year so they can get that big sale on the financial statements. And then you might see the reversal of that sale or the return of the merchandise. So that is something in audit. We would look at that like, hey, there's this big sale that we had for $1 million. And like, hey, what's going on with that? If you see that the $1 million of inventory or whatever it was returned, like in January or February, and the bill was never paid, we as the auditor are going to question that. Like, was that really a sale? It might not have been a sale. It could have been fraud. Okay. Could have been fraud, or they could have said, you can return all of it, in the next year. They sometimes call that channel stuffing, just trying to get the inventory out of the building so it looks like it's a sale. Okay, so let's look at this example. We have merchandise sold to the customer for $10,000 in December 2027. That merchandise had a cost of $6,000, so therefore we'd have gross profit of 4,000. So remember, sales minus cost of goods sold gives you gross profit. And then in 2028, if all the merchandise is returned, then it looks like we had that $4,000 in gross profit in 2027, but then it all got returned. Okay. We would definitely question something like that. Okay. This particular sale might not be a material item. $10,000 to Walmart's probably not a very material item. It's very immaterial, so we probably wouldn't even look at that in our sampling. It wouldn't even come up because it's an immaterial amount. Okay. So that would lead to the assets being overstated by $4,000 in 2027. Okay. So they give us another example here, accounting for sales returns. During 2027, its first year of operations, the Hawthorne Manufacturing Company sold merchandise for $2 million cash. And that is the first entry right there. They said they sold it for cash. If they said credit, that would be accounts receivable. Okay. Says this merchandise had a cost, Hawthorne 1.2 million or 60% of the selling price. Okay. Industry experience indicates that 10% of all sales will be returned, which equals 200,000 or 2 million times the 10%. Okay. Customers actually returned 130,000 of sales during 2027. Hawthorne uses perpetual inventory. Why did they tell you perpetual? Because that means we have to make this journal entry right here. If they had said periodic, we wouldn't have made that entry right there. Okay. But remember, not a lot of businesses use periodic. That's going to be like small mom and pop. Um, Small things. It's like even gas stations now have point of sale um, systems where they're always keeping up with the inventory now. So you just don't see periodic that much, but you still have to know it for the CPA exam. Okay. So they gave us a whole lot of information here. Okay. So they told us that 130,000 was actually returned. But remember that estimate, they said that 200,000 would likely be returned. Okay. So we would debit sales returns. There's sometimes books will call this an expense. I think it looks like an expense. I have seen textbooks call it a contra revenue account. What is that's just an expense. Okay. Anyway, it's the same thing. But anyway, it does bring sales down to net sales. Okay. So we debit sales returns, credit cash for 130,000. We take the 130 multiplied times 60 to get the cost of the inventory. We're putting it back into our inventory system. Okay. So it's going back. It's perfectly good inventory. If it's damaged, oh, or if it's worth nothing, we would not even make this entry. But they said they returned the inventory, therefore we know that it's going back on the shelves. Okay. So we have to accrue another $70,000 of sales returns. And so we're going to debit the sales returns for 70,000, credit refund liability. Okay? Because remember, experience showed that 10%, was it 10%? Yeah, 10% of the sales usually is returned. So they're basically putting aside this to make sure that they don't overstate the assets and overstate net income. Okay, so the 42,000 came from 70 multiplied times 60%. So we are debiting an account called inventory estimated returns. We don't have the inventory yet, but we're expecting it. Okay. We're going to go ahead and take that cost of goods sold down by that 42,000 as well. Okay. So then when that sale actually takes place, we'll sort of kind of a little bit of reverse. If you look at this entry, sometimes it's easy to figure out what you got to do. Okay. So that refund liability has to be debited. So it's gone away. Cash is credited. We actually have the inventory now. We don't just have an estimated return. We actually have the inventory. Okay. So we have to take that estimated return account down. Okay. All right. So now accounting for sales returns and changes in estimated returns. So if the estimate for future sales returns turns out to be wrong, the new estimate is incorporated into the accounting determinations in the next period. So going forward, okay? Don't go backwards. Because remember, a change in estimate is always prospectively. We always look at it going forward because it's an estimate. We made the best estimate we could at the time. When the estimate changes, we go forward. We don't go backwards. Okay. So suppose 2028 actual returns from 2027 sales are 60,000 instead of 70. Okay. So our change was 10,000. Okay. So we had recorded, basically we recorded this entry right here, but only 60,000 was returned, not the 70. Okay. So you can see now we did that entry with the 60 and the 36, and there's 10,000 left. So we're zero. Sometimes if you look at those T accounts, zero them out, you see that you needed a debit to the refund liability, credit to sales returns. Okay, credit to sales returns, we're crediting an expense account. So we're making the expense account go down, which will make net income go up. Okay. Debiting cost of goods sold and crediting the inventory estimated return. Again, we're looking at that one, zeroing it out. Okay. Moving right along. Okay. Then let's talk a little bit about subsequent valuation of accounts receivables. Okay. Accounts receivables come about when we extend credit to customers. A lot of people just want to shut that down and be like, no, we're not extending credit to nobody. Your sales would completely tank if you did not extend credit to anybody. Okay. Your sales go down. Guess what? Your profit goes down. So you want to extend credit. You want to do credit checks and make sure that the people who are you have extended credit to are going to pay you. All right, so when we have bad debts, we have two different ways to account for them. That is direct write-off method. They say not GAAP. Just because it's not GAAP doesn't mean we can't use it. And then the allowance method. Okay. So I'm going to do this little pyramid really quick that I started writing a few years ago just to kind of help students understand because they would get confused on the two ways to do bad debt expense and then the two allowance methods. So there's two ways to account for bad debt expense. One is direct write-off. I don't have enough room here. And the allowance method. Okay. I'm just going to abbreviate allow. Then there's two allowance methods. Okay. There is percent of sales. Sometimes they call that the income statement method. And then we have aging of receivables. Okay. They sometimes call that a balance sheet method because we use a balance sheet number. Percent of sales, we use an income statement number. Okay. All right. So let's look at direct write-off method. Even though it's not GAAP, we can still use it. It is required for income tax purposes, but some businesses do not have a lot of bad debts. If they do not have a lot of bad debts, the allowance method, it's going to be really hard to estimate them. The hotel that I worked at, we had very few bad debts. We had an occasional one. We had one big one in the many, many years that I worked there. We had a crazy guest who stayed in his room for a year and his trust fund ran out and we had no way of getting money. So we had to evict him, get him out of there, and he never paid the bill. Okay. We had to write it off as direct write off method. It was not a material amount to our financial statement. So direct write off method can be used. It just has to be an immaterial amount. Okay. So we don't have an allowance account. We don't have that contra asset or anything like that. When we figure out an account is going bad, we write it off. We debit the bad debt expense and we'll credit that accounts receivable to the, we'll call them the bad customer. Okay. So we'll credit that accounts receivable, makes their receivable go down. Now, just because we wrote it off doesn't mean it stops there. Most businesses are going to turn that over to a collection, and then the collection agency will pay like pennies on the dollar for that collection. They're still going to try to go after it and try to get all of the money. But as far as us, it has ended. Okay. They may sell it, whatever happens after that, we don't know. But a lot of students, sometimes these customers will come back and say, "Hey, I didn't pay you last year, but I have the money now." And some students will be like, "Oh, we wrote it off already." No, we will figure the journal entry out. We want your money. Okay. So that could happen. Okay. So in an allowance method, we are going to have a contra asset. Okay. So I always, if you have a problem with this, I would draw these two T accounts out. I was looking through this when I was prepping for this lecture. They did not put the T accounts on the same page. I don't like that. I want to see both of them together. Okay. They are married till death do them part. So remember, your accounts receivable has a normal debit balance. The allowance for uncollectible accounts has a normal credit balance because it is that contra asset. It sort of takes, we know that a certain percentage is going to go bad. So we're going to take it and we're going to go ahead and expense it. We just don't know who. Because if we had a crystal ball and we knew who wasn't going to pay us, we would have never extended credit to them. Okay. So the carrying value is those two accounts together. So you can see here in this example, we have accounts receivable less any allowances for doubtful accounts. Okay, sometimes they call that net accounts receivable or net realizable value. Okay, all right. So, allowance method. The bad debt expense is not recognized when a specific account is written off. It's recognized at the end of the period when we're working on the financial statements. They will go through the process of estimating what the bad debt expense will be. Okay. It's recognized earlier. Okay. So this is going to be companies like, I would think credit card companies, they have a lot of high risk. They know that a certain amount of their collections is going to go bad. So they would be using the allowance method for sure. Okay. Um, Later, when they actually figure out who, then we will write it off against that allowance count. It's sort of like we took some money in one pocket and put it over in the other, or not really money. We just set aside a certain amount. Is it going to be a perfect estimate? No, it won't be a perfect estimate, but it will be better than the direct write-off method. Okay. So they tell us Hawthorne Manufacturing Company started operations in 2027. It had sales of 1.2 million, collections of 895, leaving a balance of 305 in accounts receivable on December 31, 2027. Okay. I like to sometimes draw the T accounts out with words, okay? Because the numbers just get all jumbled together sometimes. Any new sales is going to be debited to accounts receivable. Cash collections is over on the credit side, and then we would have an ending balance. This account should not flip to the other side. It is an asset. Now, the contra asset, that's a different thing, but the asset accounts receivable should not flip. There's either a mistake or it might be in the subsidiary. They may have, it may end up where one customer might have a credit balance because they refunded them money for, like a sales return or something like that. Okay. All right. But probably we're just looking at the parent company or the parent control accounts receivable, and that should never end up over in the credit side. Okay. So a little look at that with words. Let's do the exact same thing with the allowance account. Okay. We would have a beginning balance. The bad debt expense is credited to the allowance. Any write-offs are going to be on this side. I probably should have wrote that up here. So if we wrote off, I'm going to go ahead and put that down so you already have it when we get to that point. So a write-off would be a debit to allowance and credit to the accounts receivable. A write-off does not affect that total in the net realizable value because you make the accounts receivable go down and you make the allowance account go down by the exact same amount. So that's a trick question they'll ask you. After this entry, did the net realizable or net accounts receivable change? It does not because you lowered both of them by the exact same amount. Okay. So they tell us right here, Hawthorne's analysis indicates that it expects to collect 280,000 of its accounts receivable, so it must establish an allowance for uncollectible accounts of 25,000. Okay? So basically here they found the ending balance and we backed into the bad debt expense. Okay? All right. Another reason I don't like to do these concept checks is that's a completely different problem than what we've been working on. So it can get a little confusing. Okay. All right. So now we have when accounts are deemed uncollectible under the allowance method. Okay. And I already told you where the write-offs are. You see the write-off here and the write-off here. Remember, makes both of those accounts go down. So just to kind of prove it to you, 305,000 minus 25,000 was what? Is that 280? 280,000. I missed a zero there. Okay. 290 minus 10, also 280,000. Okay. So that's what I was saying. Both accounts get decreased by the exact same amount. So the total in net accounts receivable, these two numbers added together will not change. Okay. So we didn't know who back when we made this entry. We didn't know who was going to go, whose bill was going to go bad. We just knew somebody's would be bad. Okay. Then we roll around to April the 24th, and now we know whose account will be uncollectible. Okay. Here is what happens when an account that was previously written off, they want to pay it. Okay. First thing you're going to do, you're going to reinstate the account. And you reinstate the account. You see this right here? You just do the opposite of that. You debit the accounts receivable and credit the allowance for uncollectible accounts. Notice the reinstatement increases both accounts by the exact same amount. Okay. They did not give us the entry, but we would have the next entry to collect it would be to debit cash. It's almost like the slide's missing for that. But I wanted you to see that's the entry we would make. Okay. A lot of students want to say, why don't we just debit cash 1200 and credit allowance for doubtful account or uncollectible accounts? Because by doing this right here, we go back. Let's just say that was bad customer. We are making a record that that customer came back and paid us. Okay. Sometimes they'll do that just because they want to continue to establish credit with you. Okay. So we have a balance sheet approach and we have a income statement approach. Okay. So here they give us a lot of information on the estimates to look over when you're doing the balance sheet method. Remember, you're using a balance sheet number, so you get all your numbers from the balance sheet. Okay. So let's jump down here and let's look at this aging of accounts receivables. Okay. So if you've ever gotten a bill, you might have gotten one from a doctor. I usually see these on doctor's bills, like you'll have a certain amount that's 0 to 60 days, all the way up to over 120. So they're aging all of these accounts, okay? And they're saying, okay, there's a total of 305, and each one of those sections has its own percentage of uncollectability, okay? So I'm going to write them up underneath here. So that 0 to 60 days is only 5% uncollectible. Like that's a new account. The due date hasn't came, so it hasn't been paid yet. Okay. In the next category, 10%. The next one, 20. And then look at that last one, 40% uncollectible, because if these people were going to pay their bill, they'd have paid it way back here. Okay. The further it goes out, the higher the percentage is of uncollectability. Okay. So they went through, multiplied each one of those sections by the total, and we totaled it up to be the 25,000. When we're doing an aging, a balance sheet method, this is not the bad debt expense. This is what the balance in the allowance account should be. Then we're going to back into the bad debt expense. Okay. So let's jump over here. We're almost done with this learning objective and this video. Um, I think this is a different one. They were actually using this 25 in that previous one up there. Sometimes they don't get things in the right order here. So up here, they just assumed they told you 25,000. They calculated it through that aging schedule. Okay. All right. Let's finish this one up. So here they said at the end of 2028, Hawthorne has gross accounts receivable balance of 400,000, but it believes it will only collect 360,000. Hawthorne needs the allowance to be $40,000. Okay. So it had a balance of 11,200. Here they calculated the balance. Okay, that's not the bad debt expense, but then they backed into the bad debt expense by taking the 11,200 and or taking 40,000, subtract the balance of 11,200. The allowance account sometimes can flip over to a debit balance. Remember that on that debit side of the allowance account is the write-offs. If you write off more than what your bad debt expense was, then you're going to end up with a balance over here in this account. So you will see that happen. Some of the problems will tell you, okay, we're going to work it as if there's a credit balance, and we're going to work it also with a debit balance. And they may just give you the exact same information. Okay. All right. I will see you all in the next video.